What separates the pros from the amateurs in trading? It's the ability to read and understand the language of the market, and that's exactly what we're covering today. In this advanced episode, we're diving deep into one of the essential concepts in trading. Liquidity will also uncover the psychology behind the smart money and reveal the tactics that large financial institutions use to manipulate the market, deceive traders, and set traps. Moreover, we'll unveil practical liquidity patterns that frequently form in the market, patterns that every trader must identify to stay one step ahead of the market. So make sure you watch this entire video slowly until the end and grab your notepad because we're about to equip you with some invaluable knowledge. So, traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So let's get started. Before proceeding to the liquidity patterns and liquidity scenarios that frequently form the market, let's begin with a basic introduction to smart money and liquidity and see what are the exact definitions of these terms. Let's imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding sell orders in the market. This is essential because without available sellers in the market, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders that are already present in the market in order to execute their buy-or-sell positions. It is often speculated that smart money may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. This situation can create an illusion among retail traders, making them believe that they are trading on the right side of the market. However, contrary to their expectations, the market moves in the direction of their stop-loss levels, and after triggering these stops, it resumes its normal trends. To survive and thrive as a profitable trader, it is crucial to identify liquidity on the chart. These areas, where significant volumes of orders are present, can provide insights into market dynamics and help prevent substantial losses. Liquidity can be classified into two distinct types: static liquidity and dynamic liquidity. Let's have a brief explanation of both of them. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements. To better comprehend this, let's imagine a market structure like a rally wave, consisting of a high and a low. These highs and lows represent external liquidity. Essentially, external liquidity pertains to the highs and lows within a rally wave. On the other hand, the fair value gap found within the range of the high and low are considered our internal liquidity. Price in the market always moves between internal and external liquidity. Imagine it like a continuous circle where price moves either from internal to external liquidity or from external to internal liquidity. If we look at this schematic figure here, it shows a rally wave that moves upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. The price transitions back to the external phase. Essentially, the price moves from the fair value gap to external liquidity by sweeping the liquidity above this high. With the external liquidity swept, the price then aims to balance by targeting internal liquidity. This prompts the price to drop and fill the most recent fair value gaps. Now let's move on to the static liquidity details. But before we continue, some of you guys have been asking, where do we find information about financial news and fundamental analysis? Well, we stay informed about the trading world's latest news and access the economic calendar through one of the most useful trading websites, Fastball. This website offers one of the most accurate and detailed economic calendars, allowing users to monitor key economic events that can impact the market. So if you would like to benefit from 24/7 global financial news live streaming, make sure to check the link in the description. The static liquidity refers to the specific zones in the market where large pool of money is resting, such as stop losses, buy or sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, like below equal lows and above the equal highs, above the swing highs and below the swing lows, below or above the dynamic trend lines and channels, inside the order blocks, below or above the support and resistance levels, in the Fibonacci retracement levels, near the daily candles, body and wick. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting them can lead to substantial losses. Some of these zones and patterns are especially important as they're widely recognized by traders, attracting more stop loss and pending orders, increasing the likelihood of price moving towards them to absorb liquidity. Let's now focus on practical liquidity patterns and scenarios that are more likely to drive price movement compared to other liquidity zones. Identifying these zones on our price chart enhances the reliability of our trading strategies, improving the probability of successful outcomes. The first practical liquidity pattern we should consistently seek in the market is characterized by equal lows and equal highs. As the term suggests, when the price establishes internal lows at the same level, we identify it as an equal low. Similarly, when the price forms internal highs at the same level, it's recognized as an equal high. Equal lows and equal highs fall into two distinct categories: double bottom or double top, and triple bottom or triple top patterns. Now let's delve into the specifics of each pattern and explore the psychology behind their formation within the market. Let's begin with the bullish patterns. Imagine we have a structure like this. Price created a bullish break of structure, pushed upside and then retraced back down, failing to reach the demand zone generated by the boss wave. Instead, the price formed an internal low. It attempted another push upward, but the bullish momentum was insufficient to break the recent major high. Subsequently, the price experienced another pullback and couldn't break the recent internal low, resulting in the formation of a double bottom. During this phase, many retail traders who based their trades on chart patterns entered long positions. When they identified the double bottom pattern, they also placed their stop loss orders just below the equal lows, creating a significant liquidity pool. Consequently, as you can see, price experienced an upward rally movement driven by the buying pressure of the retail traders who had entered long positions. As you are likely aware, smart money often manipulates the market, crafting scenarios that mislead traders into thinking they have a clear understanding of price action. Then they lead them into traps to trigger stop losses and generate additional momentum. To gain a better understanding of the market manipulation methods that frequently occur, let's draw a bullish trend line by connecting the recent lows in the market. Many retail traders who use trend lines for trading viewed this bearish pullback as a breakout from the bullish trend line. They were eagerly waiting for the price to pull back, providing them with a selling opportunity. They believed that the market's bullish momentum had come to an end, and the bulls had lost control when the price broke below the trend line. These traders entered the market by taking short positions as the price retraced upward. They also set their stop loss orders just above this internal high. Notably, the price showed a brief reaction to the trend line and experienced a temporary bearish wave. This reaction even induced more traders to enter the market by opening short positions and placing their stop loss orders above the recent internal high. This course of action created a perfect beside liquidity pool here, waiting to be cleared by the market. Subsequently, we can see that the price pushed higher, clearing the beside liquidity that had accumulated above the internal high. Now we have a demand zone located at the extreme, alongside a substantial liquidity pool generated by the stop losses of retail traders. In this scenario, there is a high probability that price will retrace, clearing the liquidity below the equal highs, then touch the demand zone before reversing and resuming its primary direction. Therefore, our current approach is to patiently wait for the price to clear the liquidity below the equal lows and touch the demand zone. This offers the confluence factor we seek before entering a position. Consequently, we can initiate a long position from this demand zone as the market has already collected the stop losses of retail traders, and there is no further need to collect more losses as a result. After the liquidity sweep, we can confidently enter a trade. As mentioned previously, the primary objective of smart money is to clear out all the stop losses of retail traders. Therefore, we should enter the market after stop losses have been swept. Now let's see an example. Here we have an uptrend. That price has formed bullish break-of structures. Within this context, we can identify these two potential demand areas where the price could potentially reverse and continue its bullish trend. However, the key question is, how can we determine which of these zones is safer to trade and more likely to be respected by price? As we discussed earlier, we only consider a zone as valid for trading if a liquidity sweep pattern has occurred below or above it. In this case, I will not consider this decisional order block as my point of interest because the price did not sweep any liquidity before reaching it. Instead, I view it as an inducement area that provides a liquidity pool below it in the market. Furthermore, there is a substantial liquidity pool that is formed below the equal lows and inducement demand zone, suggesting the presence of pending orders and stop losses waiting to be triggered and swept by the market. By focusing on zones with liquidity sweep patterns, we can increase the probability of trading setups that align with market dynamics and reduce the risk of falling into false signals or traps. The presence of the liquidity pool above our identified demand zone provides additional confirmation for a potential price reversal from our point of interest. Now that we have the desired confluence, our next step is to patiently wait for price to sweep the liquidity below the equal lows and inducement area. Once price enters our extreme order block zone, we can consider entering a trade. Now let's move on to the triple bottom. The same principles that apply to the double bottom pattern also hold for the triple bottom. The only difference is that in a triple bottom, the price forms 3 equal lows instead of just 2. When retail traders identify a triple bottom pattern, they enter the market by opening long positions. They also position their stop-loss orders just below the equal lows, creating a substantial liquidity pool ready to be cleared. As the market's dominant direction is bullish, it must trigger a significant number of stop losses in order to be able to continue its upward movement. Hence, when the liquidity pool, formed by the accumulation of numerous stop losses in pending orders, is cleared by the price, it signals an opportunity to consider entering a long position from the demand zone located below the liquidity pool. This is because there are no more stop losses left to be taken. Now let's move on to equal highs. As previously discussed, equal highs fall into two categories: double tops and triple tops. If we take a look at this double top pattern on the left side, it's clear that the bears are in control. After breaking the recent structure to the downside, the price rallied back up and formed 2 equal highs near the unmitigated supply zone associated with the boss wave. The existence of these equal highs created a substantial liquidity pool above them, consisting of the stop losses of retail traders who had entered the market by taking short positions after identifying the double top pattern. In this scenario, it's highly likely that the price will move back up, clear the accumulated liquidity above the double tops, trigger the seller stop losses, touch the supply zone, and then reverse to continue its bearish movement. The same concepts apply to the triple top pattern. Numerous stop losses and pending orders are situated above the triple tops, increasing the likelihood that the price will return to clear the accumulated liquidity above the equal highs. As a result, we can consider initiating a short position from the upper supply zone. Since the market has already absorbed the stop losses of retail traders, there is no longer a need to collect more stop losses. As mentioned previously, the primary objective of smart money is to clear out all the stop losses of retail traders. To increase the likelihood of a successful trade with a high chance of winning, it's essential to enter the market after stop losses have been cleared. It's important to note that if the price doesn't clear the liquidity before reaching a point of interest, there's a strong likelihood that the price will use that zone as a source of liquidity to drive its momentum. Now, let's move on to the second practical liquidity pattern that we should consistently look for in the market: trendline liquidity. Let's start with the bullish scenario. Consider a structure like the one illustrated on the left side. We can see that the price formed a bullish boss to the upside, leaving a great inefficiency behind. Following the creation of a new major high, it retraced downward and then began forming a series of small break-of structures with extremely tiny and choppy movements to the upside, without any significant liquidity sweeps. The key factor here is the repetitive formation of these small break-of structures. In this scenario, the price is slowly moving upward while forming new, higher highs and higher lows that are in close proximity to each other. As a result, a trend line is generated by these minor highs and lows. Retail traders who rely on trend lanes and chart patterns enter the market every time the price touches the trend line, placing their stop losses just below it. This approach results in the formation of a substantial liquidity pool positioned just below the trend line, waiting to be cleared by the market. Consequently, numerous stop losses are closely aligned with the trend line and are positioned by retail traders. In this scenario, it's highly likely that the price will push back down to clear the liquidity below the trend line, triggering the stop losses of retail traders. It aims to fill the inefficiency left behind and then tap into the demand zone situated at the extreme. This presents an opportunity to consider entering a long position from the demand zone situated below the liquidity pool. Since the market has already activated the stop losses of retail traders, there is no longer a need to collect more stop losses. The main purpose of the smart money concept is to enter the market only after the retail side's liquidity has been cleared. Hence, we should enter a position only when we identify a liquidity sweep on the retail side. Now let's move on to the bearish trendline scenario. The same concept applies to the bearish trendline. In this scenario, you can see that price has formed a bearish break of structure, and there is an unmitigated supply zone generated by the boss wave. The price moved downward with inefficiency, and then it started to form small break of structures to the downside repeatedly. Additionally, the price created a trend line using these minor structures. This trend line induced many retail traders to enter the market by taking short positions and placing their stop losses above the trend line. Consequently, a significant liquidity pool is positioned below the upper supply zone. All we need to do is wait for the price to clear the liquidity located above the trend line, triggering the stop losses, and then reaching the supply zone. This provides a strong confluence factor we look for before entering a position. Consequently, we can open a short position from this supply zone after the liquidity from retail traders has been cleared and the inefficiency has been filled. There is a higher likelihood that the price will reverse from the upper supply zone and continue in its dominant direction, in this case, the bearish direction. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.